If you've ever struggled to hold your bias when the market moves against you, you are not alone. But most traders fail because they don't understand how to change gears without panicking. In this video, I will show you how to navigate intraday profiles, master the New York lunch hour, and use SMT divergence to find real accumulation. At the last part of this video, I will show you how to buy sell-side liquidity exactly like smart money. Let's get started. Alright, I'm going to teach you the essentials of intraday profiles and the daily range. We're going to focus on this specific setup here. If you look at this area, that's ICT fair value gap. You can see price traded down into it earlier. It dipped in one more time. It left these relative equal lows untouched before starting to climb, look toward the previous day's high. So if we were expecting higher prices following a shift in intraday volatility. Now, how do I actually handle abandoning a bias? How do I switch gears when it makes sense? Sometimes, you shouldn't just reverse your trade. Often, it means moving to the sidelines and simply doing nothing. What are the signs that your bias needs to change, and how do you use that logic to navigate the New York lunch hour? Notice we had this low taken, then this low, and finally this low. We are seeing multiple lows get swept while the market reverses without offering any high probability shorts. This level was never hit, and liquidity was left at the previous day's high. We have a fair value gap above us, meaning to premium arrays are acting as a magnet for price. On the 15-minute time frame, you can see price consistently making lower lows until that final run higher. This was a short-term market structure shift on our bellwether chart. Price runs up, creates a fair value gap, and trades back into it. What exactly is narrative? It's the deep understanding of what price should do and why. It's knowing what signs will prove your theory is actually happening. You will be looking at this level, see if we could break out of that daily fair value gap, but we failed. Instead, the market shifted up, even if you were watching, it was not given any short setup. Then, suddenly, the market moves. No panic. We created a fair value gap on the 15-minute chart. That is immediately the area you need to watch. If price finds support there and starts to repel higher by taking out a short-term high, the stage is set for the afternoon trend. That PM session setup is exactly what we're hunting for. Because the market respected the daily fair value gap and broke a short-term high, we now have a confirmed bullish market structure shift. Price comes back down to rebalance the gap. You will not be looking at basic support and resistance. You will be looking at the fact that we broke a high, created an imbalance, and then filled it. Now, let's look at inter-market relationships on the 5-minute chart to see real accumulation. Price digs into the 15-minute fair value gap and rallies. Then it trails off back into an imbalance. Let's talk about the New York lunch hour. Usually, the morning session models, if the market is trending strongly, the afternoon can be very easy. However, we've been stuck in a small daily range for a week. You have to be precise or you'll get trapped. We failed to exit the daily fair value gap. Notice these lows here, one is lower than the other. If you overlay the Nasdaq chart, you'll see a clear SMT divergence. The S&P was stronger than the Nasdaq, which made a lower low. At midnight, we look for the opening price. If we are bullish, we want to buy near that open. Here is an advanced tip. If you know the market needs to go down before it goes up, you can wait for a shift in structure and a return to the 15-minute fair value gap. This is pure day trading. If you want to trade the full daily range, the 15 and 5-minute charts are your tools. If we are bullish, we watch for the low of the day to form around 9 to 10 a.m. New York time. The market rallies and shifts structure, even though it didn't hit my initial that level target. The SMT divergence and the shift higher should tell you everything you needed to know. Now, look at what happens in the afternoon. Price rallies but falls short of this level. It drops into a fair value gap and starts to rally again, but it leaves smooth relative equal highs. Then it drops one more time below a short-term low. Think about this low on the PM session. Usually, a bullish market runs in the morning, consolidates at lunch, and then sweeps sell stops before the final rally. Here, it didn't consolidate, it retraced. This signals a fast market. The algorithm is repricing to a discount during lunch. It creates a short-term low and leaves those smooth highs to trick retail traders into thinking there is resistance. Then it drops right below the short-term low to hit the sell stops. You have to start thinking like smart money here. This is going higher. When the market shifted bullishly and respected that 15-minute gap, it confirmed the algorithm was priming for a run to the previous day's high. You can see the displacement that energetic price run. You will be buying sell-side liquidity. The Nasdaq made a lower low, but the S&P made a higher low. This confirms the Nasdaq is under accumulation and the dip was just a stop hunt. Some people find this complicated, but you can simplify it. You can use an optimal trade entry OTE from 62% to 79%. You could use a turtle soup entry by buying the violation of a low. You could even buy the fair value gap below the 50% equilibrium. The key is using a bias that has been calibrated by what the market did at key times. At 9:30 a.m., the volatility brings the shift we look for. I don't want to chase the rally. I wait for the return to the 15-minute fair value gap. Once it hits that, I'm ready. I prefer buying the sell stops directly because that's where smart money is active. You will be buying that very candle because of the SMT divergence. That sets the stage for the final run higher. To keep it simple, here is exactly what we covered today. First, the bias shift. We learned that when your original target isn't hit, you don't panic. You wait for the market to show its hand by respecting a higher timeframe fair value gap. Second, the SMT secret. We use the Nasdaq and S&P overlay to find real accumulation. Remember, if one index makes a lower low and the other doesn't, that's your signal that smart money is buying. Third, the lunch rule. We looked at the fast market retracement. Instead of consolidating, the algorithm reprices to a discount during the lunch hour to sweep retail stops. Finally, the entry. We don't chase the rally. We wait for price to return to the 15-minute imbalance, identify the sell-side liquidity, and buy the very candle that traps the uninformed traders. By putting these pieces together, narrative, divergence, and timing, you aren't just guessing, you're trading with the algorithm. That's it, traders. Thank you for watching. I hope this explanation delivered greater clarity and practical insight that you can apply to your own trading. Make sure to subscribe and turn on notifications so you never miss future content. Leave your questions and suggestions in the comments section below. We truly appreciate your support, and we look forward to seeing you in the next episode.